Hi everybody. This is week 6 at lecture 1. This is still in topic 3 and 4. Last week, I have explained about several things that you have to understand before you can do step 5, which is doing the adjusting entries. This is step 5 in the accounting cycle. Doing the adjusting entries. So last week, I think one of the first thing that you have seen is you have to refresh your memory about the time period assumption or principle of accounting. So that principle or assumption says in accounting, you can divide the life of a business into periods. Maybe 1 year, maybe 6 months, maybe 1 month, maybe 3 months. You have to divide the life of the business into such periods because only that way you can calculate the profit for that business. If you just allow if you assume that the business has a 1 year accounting period, then every year you can close your account, calculate the profit, and after that continue with another year. If you have a business and then you want to close you want to close your account every month, it is possible. Every month you close your account, you calculate your profit, and then after that you continue the next month. But like I said last week, according to the law and regulation, every business has to close its account at least once a year. At least once a year, you have to close your business account and calculate profit, and you have to pay tax. You have to submit the financial statement to the regulators, etc. Okay, just remember that. The second thing is I think you have seen about the explanation about revenue recognition. The revenue recognition principle says in accounting, you record revenue or you recognize revenue when the transaction happen, not when you receive cash from customer. The example is like this. Let's say you have a business. Today you provide service to a customer. You charge the customer $50, but the customer said he will pay next week. So the question is, when is the time to record that $50 revenue? Today or next week when you receive cash? The answer is you have to record the revenue today because you have provided the service today. That's why I said in accounting you record revenue when it happened, when the transaction happened, not when you receive cash next week. No. Same goes to expenses. You record the expense. You record expenses when the transaction happen, not when you pay cash. Let's say, for example, you have a worker. So he works in the month of April, but you will pay him at 5th of May. So when is the time to record the salary expense? The time to record the salary expense is in the month of April, not in the month of May when you pay the cash. But you have to record the salary expense in the month of April. That is the time when the workers has work. The workers has work in April. You record the salary expense for the worker in April. Okay, that is another thing. And the next thing I think you have learned is matching principle. Matching principle says if you want to calculate profit for the month of for the year of 2021, you have to match the revenue in year 2021 and expenses in the year 2021. You cannot add revenue or expenses from year 2000 or year 2022. year 2020 or year 2022. You cannot do that. So always clear about the matching principle. And another thing that you have learned last week is how to calculate profit using accrual basis and cash basis accounting. So you have to remember that. Okay, this week you have to see how to do adjusted entries. See, okay, this is the first slide for this topic. Adjusting entries are entries required at the end of each accounting period to adjust the account to their proper amounts. Okay, there are 4 main types of adjusted entries. The first one is unrecorded receivables. The second one is unrecorded liabilities. The third one is prepaid expenses, and the fourth one is unearned revenues. Each adjusted entry involves at least one income statement account and one balance sheet account. So see here, at least one income statement account. There are 2 income statement accounts, revenue and expenses. So when you do adjusted entry, it involves at least one income statement account and one balance sheet account. So there are three types of accounts related to balance sheet. The first one is asset account, and then the second one is liability accounts, and then the third one is equity accounts. So always remember this point. So the main reason for doing adjusted entries is actually to follow matching principle. Matching principle says when you want to calculate profit for one accounting period, you have to match revenue for that period with expenses of that period only. So that is actually the main reason for doing adjusting entry. Let's say you want to calculate profit for year 2021. You have to match revenue for year 2021 with expenses for the year 2021. Then you will get profit for year 2021. Remember that. Okay, these are the 3 steps. When you want to do an adjusted entry, the first one is identify the original entries that were made. Okay, this step 1 is relevant for unearned revenues and prepaid expenses. Okay, this step 1 is relevant for adjusting entries for unearned revenues and prepaid expenses only. Okay, step 2. Determine what the correct balances should be at this point in time. Step 3. Make the adjustments needed to correct the balances. Okay, you will see how you have to follow these 3 steps. Okay, this is the first type of adjusted entry, which is unrecorded receivables. Okay, see here how to do adjusted entry for unrecorded receivables. First, precision management. Okay, this is a business. Precision management earns rent revenue of $500 in 2019, but will not receive the payment until January 10, 2020. An adjustment will be needed. So see here, this business earns rent revenue $500 in 2019, but will not receive the payment from the person who rented the space until January 10, 2020. What is the adjusted entry that has to be done? So just remember, see here, the rent revenue is 500, is revenue for the year 2019. So when is the time to record the rent? In year 2019 or year 2020? Okay, to do this adjusted entry, you have to remember the revenue recognition principle. The revenue recognition principle says in accounting, you record revenue when the transaction happen, not when you receive cash. So when this transaction happen? This transaction happened in year 2019, so you have to record the revenue in year 2019. So okay, this is the way to do the adjusting entry. First, you have to record the rent revenue. See, 31st of December 2019, you record the rent revenue. Remember, revenue increase, you have to credit. So credit rent revenue 500, but at that time, on the 31st of December 2019, you have to record the revenue, but at that time you do not receive the cash yet. So in accounting, you cannot debit the cash because you do not receive the cash yet. You debit rent receivable. Rent receivable 500. Rent receivable is an asset account. It is an asset because in the future, in year 2020, the business will receive $500 cash. So it is an asset. So let's say you have a business, you will receive cash in the future. So that is an asset because you will get something in the future. If your business has to pay something in the future, that is a liability. So remember this. The business has to record the revenue, credit rent revenue 500. Given that the business will receive cash in the future, the business has to record in account receivable. In this situation, the account is rent receivable $500 debit. Okay, the second type of adjusting entry is unrecorded liabilities. So you see here, unrecorded liabilities. The situation or example is like this. A business is assessed property taxes of $1,000 for year 2019 but will not make this payment until January 5th, 2020. An adjustment will be needed. So see here, the situation is like this. There is a business, and then this business has calculated that it has to pay $1,000 tax, property tax, for year 2019. But the business will pay the tax next year, January 5th, 2020. So what is the adjusting entry that has to be done? So this is also related to the principle that we have in accounting. The principle says for expenses, you have to record the expenses when they happen, not when they are paid. So see here, property tax. What do you think? The property tax is is an expense for year 2019 or 2020? You have to record this as an expense in year 2019 or 2020. Okay, in accounting, tax is an expense. So here, the tax happened in the year 2019. So when you see something like this, you have to be certain when this expense happened. If it happened in year 2019, then you have to record it as an expense in year 2019. Not when you pay, not when the business pay the amount of tax, but you record the tax expense when it happened. So given that the tax is for year 2019, you have to record the tax expense in year 2019. So the adjusting entry is, see here, first you have to record the expense. So in accounting, when you have to record the expense, you have to debit the account. So debit property tax expense 1,000, and then this situation shows that the business has to pay something in the future. So when the business has something in the future, has to pay something in the future, in accounting, you have to record it as a liability. So debit property tax expense 1,000, credit property tax payable. So it shows that property tax payable is a liability account. It shows that the business has to pay $1,000 in the future, in year 2020. Okay, this is the adjusted entry for unrecorded liabilities. Okay, this is the adjusted entry type number the third type of adjusting entries. Okay, this adjusted entry is called prepaid expenses. Okay, prepaid expenses is something like this. You pay an expense in advance. You pay the expense now, you do the expense in the future. So that is called prepaid expenses. So let's see here. On October 1st, 2019, Apex Incorporated pays 3,600 for 1 year's rent in advance. Rent is an expense, so this business pay the rent in advance. Covering 1st of October 2019 to September 30th, 2020. In December 2019, an adjustment will be needed. Okay, so how to do this adjusted entry? So you have to remember this. In accounting, when you pay expense in advance, it is an asset. Let's say you pay something today, but you will use, so in this example, the business pay 3,600 in 1st of October, and the business can use the building for the next 1 year, from 1st of October 2019 to September 30th, 2020. When the business pay 3,600, it is an asset. Because the business pay at 1st of October, and after that, the business can use the building for the next 1 year. That is an asset. Okay? But when the business use the building, the amount will become an expense. Okay, just like you pay top up for your handphone. I do not know whether in China you have something like this. But in Malaysia, if you have a handphone, you can purchase top up. You purchase $30 top up today, and after you purchase that top up, you can use your handphone for 1 month. So when you purchase the top up, it is an asset because you have $30. And after you use the handphone, it become an expense. Maybe today you use $1. The next day you use only 50 cents. The next day you use $2. So when you use the top up, it become an expense. But when you purchase the top up, it is an asset. So like this example, when the business pays 3,600, it is an asset because after the business pay 3,600, the business can use the building for 1 year. But when the business use the building, it become an expense. Okay. On December 31st through 2019, an adjustment will be needed. So to do this adjusted entry, you have to follow the 3 steps that you have seen in the previous slide. 3 steps to do adjusted entry. First, you have to know what is the entry or journal entry when the business pay the rent. So see here, the original entry when the business pay the rent is credit cash, because cash goes out, the business pay 3,600, so credit cash 3,600, and then the business has to debit an account called prepaid rent. Like I said earlier, in accounting, when you pay something for future expense, it is an asset. So the name of the asset account in this situation is prepaid rent. Debit, credit, cash. Debit, prepaid, rent. The prepaid rent is an asset. After that, when you want to do the adjusted entry, you have to calculate how many months has the business has used the building. So the business pay 3,600 for 1 year. 1 year is 12 months. So the payment is 3,600 for 1 year. So 1 month, how much is the rent cost for 1 month? 3,600 divided by 12 months. So 1 month is equal to $300 rent. Now, at 31st of December, the business closed its account. So how many months has the business used the building? The building has been used from October, November, December. Okay, 3 months only. So 3 months is 3 months times $300 rent is equal to $900. So now you know that from 3,600 prepaid rent asset, 900 has become an expense. Like I said earlier, when the business used the building, then it become an expense. So the business has used 3 months building. Has used the building for 3 months. So $900. Okay, when you know that $900 is an expense, then you can do the adjusted entry. You have to record the $900 as an expense. So how to record the expense? In accounting, when you want to record the expense, you have to debit the account. So at 31st of December 2019, you debit account rent expense and you credit the prepaid rent. You credit the account asset. The prepaid rent asset has decreased from 3,600. You have 900 has become an expense. You cannot do something like this. You cannot debit rent expense and credit cash. No, there is no cash out at 31st of December 2019. The cash out happened at 1st of October 2019. That is the cash out. But 31st of December 2019, you record $900 from the prepaid rent asset has become an expense. Okay, this is the type of the fourth type of adjusted entry. It is called unearned revenue. Unearned revenue is the opposite of the prepaid expense. Unearned revenue is something like this. You have a business. A customer come and pay, let's say $100 today, but the customer asks you to provide the service later. So if you receive payment from customer today, but you have to do something in the future, it is a liability in accounting. You receive the cash today, but you have to do something in the future. That is a liability. Liability is something that you have to do or pay in the future. So see this example. At 1st of March 2019, a business received 3,600 for 1 year's rent in advance. So this business, the business has a space. So the business rent the space. The person who rented the space paid 3,600 for 1 year rent in advance. So from covering from March 2019 to February 2020. So if the payment is 3,600 for 1 month, for 1 year, how much is the rental revenue for 1 month? The rental revenue for 1 month is 3,600 divided by 12 months. So every month the rent revenue is $300. Okay, so this business closed its account at 31st of December 2019. So you have how to show or how to do adjusted entry for this situation. Okay, so remember, for unearned revenue, you have to know the first thing you have to do when you want to do the adjusting entry is you have to know what is the journal entry at 1st of March. Okay, see here. Okay, at the 1st of March, when the business receive the cash from customer, the business has to do the journal entry is like this. Debit account cash. See, debit account cash there. Debit account cash. It shows that there is a cash in. The business received cash from somebody 3,600. So debit account cash. And then at the same time, I said to you, the situation is a liability because the business received cash on 1st of March, but the business has to do something to allow the person to use the space for the next 1 year. That is a liability. So it is a liability, you have to credit. When you record the liability, you have to credit. The name of the liability account is Unearned Rent. So credit Unearned Rent 3,600. Okay, now the second thing that you have to do before you can do the adjusting entry is you have to calculate how much from this 3,600 liability has become revenue in year 2019. So the business closed its account at 31st of December 2019. See how many months has passed since 1st of March. So March, April, May, June, July, August, September, October, November, December. So 10 months has passed. Or 10 months has passed from March 1st to December 31st. So 10 months. 1 month revenue is 300. So 10 months rent revenue is equal to 300 times 10. So $3,000 has become revenue. See here? From the 3,600 unearned rent liability, 3,000 has become revenue because the person has used the building for 10 months. So 10 months times $300, 10,000. So when you know that the rent revenue is 3,000, so you have to credit account unearned rent, you have to reduce the liability and you record it as revenue. So how to do the adjusting entry? Okay, first you have to record the revenue $3,000. So revenue increase in accounting, you credit. So credit account rent revenue $3,000, and then you debit or reduce the liability account. Liability account, when liability account increase, you debit. When the liability account decrease, you debit. When liability account increase, you credit. When the liability account decrease, you debit. So in this situation, the liability has decreased. $3,000 liability has decreased to become revenue. So debit the liability account unearned rent 3,000, credit rent revenue 3,000. Okay, this is the number 4 adjusting entries. Okay, like I said earlier, there are 4 main types of adjusting entries, but there are additional adjusting entries. Okay, the first one is depreciation. Okay, depreciation is something like this. Let's say you have a business and then you purchase a non-current asset. Let's say you purchase an equipment for your business. Let's say you have a laundry shop and then one day you purchase a washing machine. The price of the washing machine is $3,000, for example. And then when you use the machine, the value of the machine will decrease. Maybe when you purchase the machine, the price of the machine is $3,000. After 1 year, maybe the value of the machine has decreased to become 2,500. After the next 1 year, the value of the machine will decrease again. So the value of a non-current asset like machine, motor vehicle will decrease over time. So in accounting, we record the decrement in the value of the asset as an expense. We call it depreciation expense. So see here, adjusting entries related to depreciation. Okay, see here, the first point there. Depreciation, asset acquisition. Okay, when you want to learn, before you do the adjust entries for depreciation, you have to know how to record asset acquisition. How to record when your business purchase a non-current asset like motor vehicle or equipment or land or building, etc. So see here, asset acquisition. Asset acquisition, the value of the asset that you have to record include the purchase price plus cost to get the asset and getting it ready for intended use. So the cost that a business has to pay to get the asset like equipment or motor vehicle or building, etc. Includes this example: sales tax, shipping, installation, and other costs. Let's say you have a business and one day you want to purchase a motor vehicle for your business. For that motor vehicle, you have to pay for the value of the motor vehicle. Let's say the value of the motor vehicle is $50,000. Okay, the price is $50,000, and at the same time you have to pay other you have to make other payments like a payment for tax, shipping, delivery or installation, insurance, etc. maybe. So to record the value of an asset, you have to add the purchase price plus the other costs that you have to pay during the purchase. Okay, see here, this is an example. Okay, see, let's say in the green box, see the detail about the journal entry. Purchase a sewing machine for $5,450 and $50 for shipping or delivery. Paid $3,500 cash and will pay the supplier $2,000 later. See here, the price of the sewing machine is $5,450, but when the business purchase the sewing machine, the business has to pay $50 for delivery. The seller of the sewing machine said the seller charged $50 to deliver the sewing machine to the business. So when you record this purchase of sewing machine, you have to record it at $5,500. When you record the sewing machine in your account, the value of the sewing machine is the price, which is $5,450 plus the cost that you have to pay to acquire or to get the sewing machine. In this example, the cost to get the machine is $50, which is the shipping cost. So that's why when you record the sewing machine in your account, you have to debit the sewing machine $5,500, not $5,450, but it is $5,500, the price of the machine plus the shipping cost. Why you debit the account? Because asset increase, you debit. The sewing machine asset has increased from 0 to an amount, which is 5,500. And then see there, you debit 5,500, but you credit first. You credit cash 3,500. Why you credit cash 3,500 because the business pay cash 3,500. When the business pay cash goes out. So asset cash decrease. When asset decrease, you credit. That's why you credit account cash 3,500. And then the business will pay the supplier $2,000 later. So it is a liability. When a business will pay later to a supplier, it is a liability because the business has to pay something in the future. So the account that we use in accounting to record this kind of situation is account payable. When a business owe money to supplier, we record in account payable. That's why you can see there liability account payable credit to 1,000. So this is the way to record asset acquisition. Asset acquisition. Okay, this several points related to depreciation. As time passes, a fixed asset loses its ability to provide useful services. This decrease in the usefulness is called depreciation. Okay, first, the second point, depreciation is the process of cost allocation that assigns the original cost of plant and equipment to the periods benefited. So, just remember about depreciation. It shows the decrease in the value of a fixed asset over the year of usage. Okay, and then see here there is another term that you have to know, book value. Book value is the asset original cost less any accumulated depreciation. Okay, you will see that after this. And then another term that you have to know before you can do the adjusting entry depreciation is salvage value. Salvage value is the amount expected to be received when the asset is sold at the end of its useful life. Excuse me. So you will see that later also in the next slide. Okay, there are several methods that can be used to calculate depreciation. Straight line method, reducing balance method, unit of production method or something. I think at least 3 or 4 methods that can be used to calculate depreciation. But in this course, you have to know about only one method only. The method is called straight line method. Okay, when you use straight line method to calculate depreciation, cost assigned equally to all periods benefited. So see here, this is the formula that you have to use to calculate depreciation using straight line method. The formula is in the first green box. Annual depreciation expense equal to cost minus salvage value divided by estimated useful life. Okay, cost is the value of the asset. For example, let's say you purchase a sewing machine. The value of the sewing machine or the amount you record for the sewing machine is 5,500. That is the cost. Salvage value is the value of the asset after its useful life. At the end of its useful life. Let's say you purchase a sewing machine. The cost is 5,500, and you expect that the machine can be used for 5 years. So salvage value is the value of the washing machine after 5 years. Let's say after 5 years, the washing machine can be sold as a recycled item, 50 ringgit. So that is the salvage value. Some assets do not have any salvage value. Maybe you have a business, and then you purchase you purchase a furniture. You think that the furniture can be used for like 10 years. After 10 years, you cannot sell the furniture, for example. So that is an asset with zero salvage value. But if you purchase machine, most of the time there is a salvage value. You can sell it as a recyclable item, or sometimes you can sell the machine as a second-hand item. Purchase the machine today, after 5 years, you can still sell it as a second-hand item. So maybe sometimes some assets have salvage value, and some assets do not have salvage value. And then estimated useful life is the how many years you estimate the asset can be used in your business. Maybe some assets, maybe for example, you have a laundry shop, you purchase a washing machine, and then you estimate the washing machine can be used for 5 years. So that is the useful life. Let's say you purchase a lorry for your laundry shop, or you purchase a van for your laundry shop, and then you can estimate, oh, this van can be used for 10 years. So that is the useful life. So it depends on the asset. So now, see here an example how to do adjusted entry for depreciation. Second point in this slide. A business purchases a washing machine $5,000. The useful life of this washing machine is 4 years, and the salvage value is $600. So how to do the adjusted entry? Okay, the first step is you have to calculate the depreciation expense using the formula. Okay, now you see here. Annual depreciation expense equal to cost 5,000 minus salvage value $600 divided by the useful life 4 years. So the depreciation expense every year is $1,100. That is the first step. The second step, you have to do the journal entry for this depreciation. How to do that? You have to memorize this. You have to debit the depreciation expense 1,100, and then you credit an account called accumulated depreciation 1,100. The detail about this transaction is to record annual depreciation for the asset or for the washing machine. Always remember, when you have to do adjusting entry for depreciation, first you calculate the depreciation expense using the formula, and then after that you record the transaction in the general journal format. Debit depreciation expense, credit accumulated depreciation. The accumulated depreciation is specific for an asset. In this example, the asset is washing machine. Okay, I think we stop here. This is the end of the lecture. Do not forget to write your name and matric number in the comment section. I will take it as the attendance for your lecture attendance. And you have to watch the lecture video during the lecture hour. And also have to remind you that in UPM, if you attend less than 90% of the lecture, you cannot do the final exam. Okay, so be careful. You have to watch all the lecture videos and put your name in the comment section. Thank you very much. Bye bye.